All right, welcome to the October 11th edition of the Fats, Fuels, and Oils webinar. As you can see from my background, I still am not quite home. I've got power and internet finally yesterday, but I have a broken pipe now. So unfortunately, the bulk of a lot of last week has been meeting with contractors and adjusters and all kinds of people that you don't really want to see in your life. Anyway, so once again, I apologize. The report is not posted, and so we won't have the charts and stuff that we usually have to look at. But after the webinar, I'm going home, and next week we should finally be back on a normal schedule, and I should be a bit more prepared, I guess, for or at least have the reports and stuff posted. All right, so what's going on right now? We are in kind of this period we go through every year where we're kind of after the U.S. growing season, just before or at least very early in the South American growing season. And so news flow is not super huge right now. That said, there still are concerns about dryness in Argentina. Now it's early for Argentine planting, but with each passing day, I think those concerns grow, and another day without rain means that there's less time to recharge the soil moisture once it does start to rain. Right now, that's not a huge deal, but it will increasingly become part of the market's focus. I think balancing that right now is the fact that early planting in Brazil seems to be going well, and rainfall totals there have been sufficient to kind of support early crop development. And so I think right now, what you would think, or what I would think as an analyst, is that if Brazil plants everything that they expect to plant, and the weather supports that crop, the Argentine crop can be a little bit less, and probably still South American production, depending on what goes on in Paraguay and Uruguay, of course, but in general, South American production can still be above last year's level, and maybe well above last year's level if Argentine growing conditions improve. You could get 150 million ton crop out of Brazil, and a 45 million ton crop or so out of Argentina. And that would have a big impact on the oilseed complex, because outside of sort of early Argentine growing conditions, one of the big questions for the market right now remains, what is the size of the U.S. crop? And tomorrow we'll get USDA's latest assessment of U.S. soybean production and average U.S. soybean yields. The general trend, if you look back at WASDE reports through the years, or at least over the last 20 years or so, has been that the October or the September report generally doesn't have big swings one way or the other. Now, there have been years over the past 5 years or so where we have seen larger changes, but in general, if you look at kind of the long-term average, the September report is not the report that where USDA has made large adjustments, and they've tended to wait a little bit longer to make those adjustments in the October and November report, because I think in part farmers have started to plant soybeans earlier, and this started a couple of years ago, particularly in Iowa and in Illinois. I think USDA may have gotten a little bit better sense of the crop this year, and I think part of that was reflected in the fact that the FSA insurance information was complete enough last month for USDA to make some acreage adjustments, which is not typical for the September report, but also probably gives you a little bit of sense of where their assessment of the crop is. I say all that to say that while the crop can probably continue to get smaller, I don't really expect another huge cut in the yield in the October WASDE report. Now that I've said that, the USDA probably will make a significant adjustment, but whatever that adjustment is, it will have a significant impact on the oil balance sheet and on oilseed complex prices more generally, because even though the grain stocks report that was issued at the end of last month showed that last year's crop was bigger, and so the carry out and carry into the 22-23 season is a little bit bigger, given the adjustment in the crop in the September report, we're still expecting a relatively tight carryout. Now, we talked before, and this has been a trend carrying over from last year when canola production was short, where any reduction in crop size, we are going to favor reducing exports, seed exports, as opposed to reducing crush. Doesn't mean we don't cut our crush forecast at all, just means that we probably will cut more out of our export forecast than we will out of our crush forecast. And if you look at seed exports over the first, if you look at soybean inspection, export inspection data over the first month of the soybean marketing year, you can see that that exports have gotten off to kind of a slower start than they typically do. And so that kind of backs up this idea. And I think that there probably is a fair amount of room to cut US exports before you really have to start digging into the crush. Not that I would, if USDA reduces the crop size by 100 million bushels, not that I would just take 100 million bushels out of exports and leave crush alone, but I probably would do 75-25 at max, and maybe even favor exports a little bit more, given the fact that we've got a relatively good start to the planting season in Brazil. I think that argues even more for favoring reductions in US exports as opposed to reductions in crush, because if Brazil is going to grow 150 million ton crop, then they can export a lot more soybeans to China and reduce the pressure on China to buy soybeans from the US. So, and beyond that, if you look at China's demand or China's projected demand, given what we saw in 21-22, where it looks like soybean meal demand per hog is probably a little bit lower than we all expected it to be, or than I expected it to be, certainly. And so their demand for crush is a little bit lower, and then their demand for imported soybeans is a little bit lower. Their crush margins also have not been that fantastic, and so at least right now, there's not going to be a big push for China to buy a bunch of soybeans from the US. Not that they won't buy large amounts right now. They always do. It's just a seasonal thing. At harvest, we ship a lot of soybeans to China. But what I'm saying is that I don't know that there's that huge pressure because the US crop is shrinking. There's a huge pressure or big competition between the export market and the crushing market. The other reason that China's demand might not be as strong is because Chinese hog numbers, I think, are down or are relatively low. You've seen some announcements where China has been auctioning off pork from their pork reserves. And I think that that probably means that that their hog numbers are a little bit lower than, again, I had anticipated they would be at this point. And so that's just another reason to kind of favor cutting my export number as opposed to cutting my crush number. But we'll kind of see what USDA says tomorrow, and then we'll go from there. In the oil balance sheet, we have almost all of the data for old crop for 21-22. And so USDA might make some minor adjustments. I think that they probably need to raise their export number a little bit, not a lot, but maybe by 50 million pounds. And they probably will cut that out of biofuel demand. We've got our exports are a little bit more than 50 million pounds above where USDA September WASDE was, and our biofuel demand is about the same amount below where they are. We're also below USDA on non-biofuel demand. We're about 100 and little less than 100, about 85 million pounds below where USDA is on non-biofuel demand. So I think they will make some minor adjustments to the old crop balance sheet to kind of true up with the data that we have. We just need sort of one more month of crushing data, export data, and then a couple more months of biofuel feedstock data, and we'll be complete for 21-22. For the new crop, I think it depends entirely on exactly what USDA does with the soybean crop. But again, I wouldn't expect a significant change in their crush forecast, and so as a result, I wouldn't expect significant changes in their oil balance sheet. They might sort of do what they have traditionally done relatively early in the season when they've had to cut crush, which is swap out some biofuel demand for non-biofuel demand to keep the non-biofuel number up there. In September, they were at 13.7 billion pounds, which is pretty close to where we are. We're at 13.75. But again, if they do need to make some changes, that's probably where they could do it. Their export number at 1.4 billion pounds is a little bit above where we are, but I think that the last 2 years would kind of argue that exports might be a little bit stickier than we all anticipated, especially given the fact that we've seen the spread between soybean oil and palm oil widen out to historic levels, and we still haven't seen sort of that huge drop off in U.S. soybean oil exports. The Argentine basis remains low relative to the U.S., and so maybe that's something that they can kind of hang their hat on and trim exports by a little bit. But I think that they're probably going to be relatively cautious in cutting U.S. soybean oil exports, just because we don't really know kind of where the bottom is. If you look at the historical data, I would argue that the bottom is around 1.1 billion pounds for U.S. exports. But the last couple of years, where again we all had kind of expected this really sharp tightening in U.S. stocks, and to kind of find out where the bottom is in U.S. soybean oil exports, that just hasn't materialized. So while U.S. exports have been higher than pretty much everybody expected going into the year, because of that, I think that they probably will be a little bit more conservative in their export forecast, at least until we start to get into the year and see kind of what the first quarter looks like in terms of U.S. shipments. Now, with the Argentine basis where it is relative to the U.S. basis, I think much like the beginning of the soybean export season, we probably will get off to a slow start for the U.S. soybean oil export season, but we will see what they say. For canola, we'll get the same kind of adjustments to canola acreage this month that we got last month for soybeans and corn as well, but for our purposes for soybeans, I don't have a great sense of whether USDA will raise canola acreage in the US or cut canola acreage in the US. They started out, or they have a relatively small number, just under 2 million acres in the September WASDE. And so given that last year we did 2.15, and that was up a bit, that was probably a bit above trend. I think just without any other knowledge about what's going on with canola acreage, I could see them raising it a little bit, and that may raise their forecast for U.S. canola production, because while their yield number again isn't in line with sort of trend, it's still just a little bit below trend yield. I think that that's probably a relatively good place for it to be. The canola growing season was pretty good, but again finished kind of on a little bit drier side, and so maybe they raise acres a little bit, cut yields a little bit, and production stays relatively stable. And if that's the case, then I think that for canola it's a little bit different situation, where the vast majority of U.S. production goes into crush. There isn't really a huge export number to cut anyway. So generally, especially at this time in the marketing year, changes in production translate into changes in crush. The balancing factor to that is what they do with Canadian production, and as a result, U.S. imports. So in theory, they could reduce their Canadian production, canola production, and then cut their Canadian canola seed export number, reducing U.S. supplies and maybe resulting in a little bit larger cut to U.S. canola crush than just the change in the U.S. production would imply. So for Canada, we've had another Stats Canada update or estimate for production, and that came in right around 19 million tons. That's about 1 million tons below where USDA is. So they could cut their Canadian canola production number. Historically, the Canadian crop, the Stats Canada starts relatively small and then kind of gets bigger through as they go through estimates. We won't get another Canadian canola estimate, I don't think, until December, or maybe even a little bit later than that, but I think it'll be a little while. They do two relatively quickly back to back sort of, and then there's a little pause between the last one and when we get the next one. And so USDA may hold their number or may keep their number a little bit above where Stats Canada came in with their last estimate anyway, just because, again, sort of historically, Stats Canada is kind of raised their number as they've gone forward. Now this year they didn't do that. Their first estimate came in a little bit lower. I guess maybe they did do it this year. I think their first number came in a little bit lower, and then their second number came in just above where their first number came in. So I apologize, but I think that may have been what happened. Anyway, again, with Canada, I would still favor reducing their canola seed exports as opposed to reducing their weekly crush data for this past week. suggests that canola crush for September is going to be around 820,000 tons. That would be a record for the month and unchanged from the prior week. The weekly crush came in just a little bit above where sort of the 5-year average change from week to week would suggest it should be. And because the week ended, there were only 2 days in the week that actually count towards September crush. It didn't really have a significant impact on our estimate for September. So we're still at 820,000. That is a pretty strong start to the marketing year. The August crush was a little bit below where we were last year, and while last year's marketing year crush was impacted by the drought, the August crush represents a little bit of the prior year's crop, and so last year's could be a little bit higher, and this year's could be a little bit lower because again it represents part of the prior year's crop. But if the September crush does come in at 820, like I said, that would be above where we were 2 years ago when they crushed a record 10.4 million tons. And that would suggest that that crush probably is going to remain relatively strong throughout the marketing year. Right now, we've got it at the marketing year crush for canola at 10.35, so just below that record level. But if we continue to get weekly data that suggests that October and November are going to be above where they were 2 years ago, then we probably will end up raising it to that record level, or maybe even a little bit above that record level. Of course, much like the US, Canadian crushers are undergoing an expansion in capacity. And so that probably will also play a little bit of a role in what 22-23 crush looks like. And again, it's a little early in the season to tell, and given where our estimate for the crop size is right now, it's hard to push the canola crush in Canada up much higher than we have it. I changed our forecast for Canadian production down to just above where Stats Canada was. I'm down to like 19.25 million tons. And to do that, I had to cut mostly out of exports. I didn't really change the crush number, again, just based on the idea that the September volume was so high that it just didn't make sense to also cut the marketing year crush forecast. But I did cut the carry out a little bit. Now, the last couple of years, for the most part, Canadian canola carry out has come in a little bit higher than expected, and so I probably would have liked to cut the carry out a little bit more than I did, but I went down that path for 2 years and ended up being too low for most of the year. So this year I'm going to try and be a little bit more conservative in the changes that the balance sheet suggests should occur in the Canadian canola carryout. So on the oil side, because again, I don't expect that we probably will see big changes in the crush. I don't know that there will be significant changes in USDA's Canadian canola oil balance sheet. We're pretty much in line with USDA on most things. The only place where we have a huge difference is in our stocks number. Again, we reconcile to a different series than USDA, and so our stocks number looks a lot different than USDA's. But in general, they have stocks that are relatively steady year over year. In September, they predicted stocks that were relatively steady year over year, growing just a little bit. And we have essentially the same thing. So from a trend perspective, I think we're pretty much in alignment there. And the rest of the supply and demand data is also generally in alignment with where USDA is. On the old crop side, we've gotten most, much like the US soybean oil. If you use an October to September marketing year for all veg oils and protein meals, then there's a couple months worth of data left. So USDA might true up a little bit to some of that. But in general, we're not super far off from them again. Our production numbers are generally in line. The only difference is a modest difference in domestic usage, where we're a little bit higher than where USDA is. Okay, so on to palm oil. And last night we got the monthly supply and demand report from the Malaysian Palm Oil Board, and it came in largely as expected, which is to say that that the Malaysian Palm Oil Board showed a big increase in stocks, which happened to be the ending stocks for the 2021-22 marketing year. They came in at 2.27 million tons. That was a little bit below the 2.3 million tons that we were projecting, and the highest level since 2018, 2019 on a end of marketing year basis. It was the highest stocks level for any month since October of 2019, 2020. The big question going forward for Malaysia and the palm oil price continues to be export demand. The MPOB estimate for September came in at 1.42 million tons. Again, that was relatively close to the 1.45 million that we predicted, and it leaves exports at just below 15.5 or 15.6 million tons. That's the lowest exports that they have had since 2007, 2008, and just below last year's 15.9 million tons, essentially. Part of the reason that exports have remained kind of weak is because Indonesia kind of has extended their suspension of the export duty, and so Indonesian shipments are a little bit more competitive than Malaysian exports. But still, the surprising thing is that we haven't seen a more significant shift in or more substantial substitution of palm oil for soybean oil. Now, with the Argentine basis and Argentine supplies, I think that probably makes Argentine soybean oil certainly a lot more competitive than with palm oil than soybean oil out of the Gulf. But there still is a fairly hefty premium for soybean oil over palm oil, and certainly well above the sort of the long-term average for palm oil. If you look at the chart, you can see the nearby kind of continues to run up, but where the nearby is we're far enough along in the month that the nearby is really thinly traded, and so that one is not super informative, or that spread is not super informative. The spreads beyond the nearby, the contract months that match up with soybean oil and palm oil, so the December, January, and March contracts, they've all kind of stalled out at around 30 cents or just below 30 cents. And that probably makes sense. Again, I think that ultimately we'll start to see that come back down, but not before we see an increase in palm oil exports. And so as long as palm oil exports kind of remain at current levels, I think that spread probably remains closer to 30 cents than it does to 20 cents. And cargo surveyor data for the first 10 days of October suggest that the trend is going to continue with shipments down more than 10% relative to the same period in September. Of course, it's just the first 10 days, and those numbers can shift a lot in the coming weeks, but it doesn't really tell you that it doesn't suggest that we're going to have a big pickup in exports in October. And so again, I think that probably argues that the spread stays a little bit closer to 30 cents than it does to 20 cents. As far as the next marketing year, we expect that that production will continue to recover a little bit from the 2021 low of 17.9 million tons. This year it was around 18.2 million. So you can see a little bit of a recovery there. And just to fill in the picture, production in September came in at 1.77 million tons. That was a little bit above this 1.75 million tons that we had forecast. And so that trend we expect it to grow slightly in 21-22. If there's not an increase in export demand, which again we're predicting exports for 22-23 of 16.8 million tons. But at this point, excuse me, that's a little bit more based on a little bit more production, a relatively widespread to soybean oil, and just generally more supplies available. But that has also been true for the last several months, and we haven't really seen that make a difference yet. And so if we don't get that pickup in exports, then stocks could climb from the 2.2 million pounds or 2.3 million tons that we saw at the end of 21-22. We've got them tightening a little bit down to 2.15. That still is above sort of the 2 million ton line that we think of as either bullish or bearish for palm oil prices. But if they do tighten slightly and soybean oil prices remain relatively elevated, then we think that that palm oil prices probably could rise to narrow that spread. Now, if you look out a year from now, we don't have that spread back at 15 cents. I think we have it closer to sort of 25 cents, or maybe a little bit lower than that, maybe sort of 22 or 23 cents. So I'm not talking about palm oil prices just ripping higher, but just moving high enough that it sort of narrows that spread down just a little bit. Again, all of that depends a lot on the pace of palm oil exports, and I think that the first couple of months, or at least if Indonesia doesn't extend the exemption from exports for tariff, the exemption for tariffs for exports, sorry, then if they don't extend it past October, we would expect that Malaysian shipments would need to start to pick up in November to start to justify our marketing year forecasts. If that exemption expires or doesn't expire, then we probably will start to cut our Malaysian palm oil export number a little bit sooner rather than later, just because of the more competitive supplies out of Indonesia. All right, with that, let's switch over to biodiesel. And again, apologize that we don't have our usual charts to look at. I've also highlighted in my spreadsheet the week that I'm going to talk about, so I don't repeat what I did last week and quote you next week's forecast. So in the past week, renewable diesel margins jumped pretty sharply. They gained 41 cents by our estimation to 2.250 a gallon, or just a little bit more than 250 a gallon from 210 a gallon. And biodiesel margins also rose from 118 to 122. Both margins rose despite modest declines in there was a modest decline in the biodiesel price. The renewable diesel price actually jumped pretty sharply, and that accounted for a big chunk of the gain in the renewable diesel margin. So renewable diesel in the California market jumped from 333 to 371. If you compare that to the price of biodiesel without the credits, that dropped from 370 to 366. So at least they're a little bit more in line. The biodiesel price with credits has been stable for quite a while, and so the changes in the credits have really accounted for the changes in the difference on the revenue side of biodiesel, whereas renewable diesel prices kind of came under quite a bit of pressure over the last several weeks, dropping from 373 in late August to a low of 333 in September, before again jumping pretty sharply last week. And what we saw last week also was a big recovery in energy prices more broadly. Crude oil jumps back above $90 a barrel, and gasoline prices have stopped going down and have started to go up. As a result, we probably will raise our forecast for biodiesel and renewable diesel prices, although probably not so much for biodiesel prices, and we'll probably raise our renewable diesel price forecast a little bit more. On the feedstock side, we really didn't see any changes or any significant changes in the fat and grease prices, and even for soybean oil, RBD soybean oil, we only saw a modest decrease from 81.82 a pound down to 81.10 a pound. So on the feedstock side, it's not really doing much to change the margins for biodiesel, renewable diesel. It very much has been sort of a revenue thing over the past week anyway. For the credits, the RIN market has continued to widen, or the spread between D4 and D6 RINs have continued to widen. So we're going to build that into our forecast going forward. We had those two continuing to narrow into the end of the year, but it seems like the market is probably getting a little bit more comfortable with ethanol production versus ethanol demand, and probably is less worried about the ethanol blend wall than it has been for most of the year. And I think that has a lot to do with the demand destruction that we've seen in gasoline consumption due to the relatively high prices. Gasoline, at least U.S. gasoline futures, are bouncing back in part on the strength in food prices, but also in part because gasoline stocks have been relatively low. They're not necessarily relatively low because there's been huge consumption, and in fact, if you looked at consumption over the summer, it was down sort of at or below the levels that we saw during 2020, or while we were still sort of in the thick of the pandemic. So gasoline demand destruction means that we don't need as much ethanol, and I think that probably explains a bit of why we're starting to see that spread narrow out heading into the end of the year. And the way that we're going to handle it is we probably will build that spread slowly through the end of the year. We might tighten it up just a little bit in December, just because I think that even if gasoline demand is significantly below what everybody expected earlier in the year, or even from right now, there probably will still be a little bit of people that are short D6 RINs that need to need to bid up the price a little bit to meet their individual mandates. And so we probably will narrow it a little bit narrow that spread a little bit in December, and then widen it out starting in January. And then next year, we probably will keep the spread a little bit wider than we saw this year. And so that would suggest that D4 prices could be a little bit lower next year than they are this year, if you just kind of take an average. And we probably won't get back to challenge the highs that we saw this year, just based on the idea that that spread's a little bit wider, and D6 prices might be a little bit weaker than we were expecting a month ago, or even a couple of weeks ago. For the LCFS credit price, the LCFS credit price seems to have bounced off the $60 a ton level. Now, this will be the third time I think that it bounced. I think it bounced at sort of 150 and then 110 maybe, and then 90. So maybe this is the fourth time that it bounced. The $60 level makes sense from this perspective. I think if you believe that $50 a ton is kind of the real floor for LCFS credit prices, for markets that aren't just sort of financially traded, like the futures market, let's say, if this was a futures market, I think that traders would push the price down to the $50 a ton level, just to test and see what demand looks like there, or what the market looks like at that level. For markets that are more closely attached to the real world, I think that at the very least, they tend to approach those kind of barriers or support levels more slowly and more cautiously than they do in the futures market. In the futures market, it tends to be a magnet. In the in other markets, in sort of cash markets, I think it doesn't work in the exact same way. And I think, again, that prices may approach that a little bit more cautiously. So bouncing off 60 kind of makes sense. It doesn't necessarily mean that we can't get down to 50, or that we won't get down to 50. A lot of it will depend on, of course, renewable diesel production and the amount of renewable diesel production that is shipped into the California market. Given what we've seen in renewable diesel margins, we kind of still expect renewable diesel production to remain flattish over the next couple of data releases from the EIA, and then, of course, to pick up into the end of the year in November and December. And the improvement in margins this past week, if that trend continues, or if margins kind of stay at that same level, might suggest that we start to get we start to see larger production in October than we're forecasting. But 1 week does not a month make, and so we'll kind of continue to monitor those, and then make adjustments to our production forecast as we go forward. In terms of what we expect for margins, we're still expecting margins for biodiesel to remain historically high. So kind of not exactly where they are now, but still probably over $1 for most of the rest of the year, maybe just under $1 at the very end of the year. For renewable diesel, again, at least right now, we've got margins narrowing down to towards the $2 level, not quite getting to the $2 level, but we'll have to see what happens again with renewable diesel prices and renewable diesel margins over the next couple of weeks. If renewable diesel prices seem to hold on to the recent gains, then margins probably will be a little bit higher than we are expecting. Okay, I think that is pretty much all that I have to cover this week. I see we have one question. It seems like the spread will widen between palm oil and soybean oil at this time. The end users don't seem to overlap enough to force convergence. Where do you think the spread will be in January? So I think that you're right in that we haven't seen a lot of substitution, or the amount of substitution that we have typically seen over the last several years, for sure. Over the last several years, if the spread got out to 10 or 15 cents, and it generally didn't get out to 15 cents, but if it got out to sort of 10 cents or so, we started to see more substitution in the export market. And that's not something that we have seen a lot of. We are seeing some areas where there is palm oil substitution. And so there has been some growth in US palm oil imports. And that is due in part to the cost of soybean oil. And so palm oil tends to work a little bit better into feed rations than soybean oil does, or certainly than soybean oil did when soybean oil was back at its highs. With soybean oil backing off a little bit, that may reduce that demand a little bit. But I think in the longer term, if you think about where renewable diesel demand is going to be, and the fact that fat and grease supplies are relatively fixed, that palm oil is going to have to take some of the load off soybean oil for the feed industry, and canola oil probably in the food industry, if we're going to start to use as much soybean oil as we all are projecting that we're going to use. So it's a little bit of an odd situation, not only because we're sort of at historic levels with the spread, but also because we haven't sort of seen the kind of substitution that we would see, or that we would expect given the historical levels of the spread. As a result, I don't think that we're necessarily going to see a big correction in the spread like we would kind of typically expect to see. So 2 years ago, the spread ran up and touched 30, and then it ran straight back down, and got back down pretty close to kind of the long-term average, and then it has kind of slowly built up over the course of this past marketing year to the 30-cent level. I think that you probably could see that spread narrow down to maybe 25 cents, maybe a little bit below 25 cents. But again, a lot of that will depend on the export demand for palm oil, not only for Malaysia but also for Indonesia. And while Indonesia has this program where they have eliminated export tariffs, it doesn't mean that we're necessarily seeing huge demand for Indonesian palm oil. All of that could change next month, and all that really needs to happen for that to start happening is you need restocking in India and China, or both. I think you probably need more growth in those markets than we have seen historically, because the demand for palm oil from Europe has fallen a bit due to the restrictions, and I guess also due to the preference for using either non-vegetable oil feedstocks for biofuels, or rapeseed oil for European biofuel production, or fats and greases and UCO, sort of like the US. And so I think that in order to really get that spread to narrow, you're going to need to start to replace that demand from Europe. And so far, again, not only have we not seen sort of replacement of that demand from Europe, we haven't seen significant restocking in India and China. I think that at some point China is going to have to do something. Just kind of looking at the Chinese vegetable oil balance sheet, if you look at sort of a roll up of all of Chinese vegetable oil in a balance sheet, I think they're going to need to do something to increase their vegetable oil consumption. Whether that will be palm oil or not will depend a little bit on what happens with the war in Ukraine. I think that China probably has gotten some more sunflower oil from Russia than they typically have, but I'm not sure that it's enough that they won't at some point need to come back and restock palm oil as well. But again, very long-winded way of saying, I think that that the spread narrows some through the balance of the year, but I don't know that I see it getting below 20 cents. And I suppose there's a scenario that I could construct that would say that it widens out. If you don't see any increase in palm oil exports out of Indonesia and Malaysia, and you start to see an increase in production in one or both of the areas, then that discount probably becomes wider. Or if you see palm oil stocks in Malaysia sort of build to 2.5 million tons or 2.7 million tons next year, then I would say, just not knowing anything else, I would say that the spread probably breaches the 30-cent level and could move to 35 or 40 cents. But I expect in what we're forecasting is that spread narrows down and gets down to 25 cents or maybe a little bit below 25 cents over the course of the next year. In terms of January, it's probably above 25 cents, probably somewhere between 25 and 27, or maybe a little bit above 27 cents. How many pounds of soybean oil are you expecting the U.S. feed market to release back to the market in the next fiscal year, assuming feed switches to palm oil? So if you look at the reduction year over year in projected non-biofuel demand, we have non-biofuel demand dropping from 14.35 billion pounds to 13.75 billion pounds. So that's 600 million pounds. And if you assume that the bulk of that probably comes out of the feed industry, just because the food manufacturers and the plastic manufacturers or other uses for soybean oil, generally soybean oil is a small part of the overall cost structure, and they have sufficient margins to absorb the higher soybean oil costs, or they can pass the higher soybean oil costs on to their clients if they have to, because it doesn't turn out to be such a big number anyway. Unless you're making mayonnaise or salad dressing or something like that. So I think that the bulk of that probably comes out of the feed industry, and just kind of a very rough estimation, if it's 600 million pounds that we're going to need to reduce soybean oil consumption by, then I think you could probably say that probably 500 million pounds of that would need to be switched to palm oil. Maybe it would be a little bit less, maybe it'd be 450 million, but I think probably 500 million out of 600 million is kind of the right kind of ratio. And so if we're gonna need to cut non-biofuel by more or less, I would sort of kind of keep it at that 5 to 1 kind of ratio, at least until you get to the point where RBD is so expensive that that the food manufacturers really do need to think about switching their recipes in a significant way and switch to canola oil. Now it's obviously also a little bit tougher for them to switch to canola oil because generally canola oil is a premium to soybean oil. So I would also say that to figure out when that happens, monitor the spread between soybean oil and canola oil. I know that's hard given that we report a Los Angeles price for canola oil and a Chicago price for soybean oil, but we do expect that again, we expect that spread will narrow a little bit as well, and that suggests that as canola oil becomes more competitive, it's probably starts to get a little bit easier for some food manufacturers to start considering switching to canola oil. It's a much more difficult thing to switch the recipe in the food industry than it is in the feed industry, but not impossible, especially again if that spread between canola oil and soybean oil continues to narrow, and especially if you start to see RBD canola oil at a discount to RBD soybean oil. All right, I think that is everything for this week. Thanks for attending. Thanks for your patience over the last couple of weeks. I promise that next week we will be back to normal, and you will see the same old fast market screen that you usually see behind me. Have a great week, everybody, and I will see you all hopefully next week.